Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show. So much to go through today with all that movement in the market, some stuff going on in the commodities sector as well, and also any stock codes you'd like me to have a look at. Get them ready. We'll go through them in the second half of the show. Now, as always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all of that, let's get into this week's first chart. And starting off with the ASX 200. And well, we've got another breakdown in the ASX 200 this week. Is this about to get a lot worse? I'll discuss that in a moment. I'm also going to show you a graph that may hold the answer. And then over in the US, we've got a spike in volatility and a breakdown in a key index. Are all those calls about a bubble right? I've got a graph you're going to want to see. I'll show you that and tell you a bit more about that shortly. First of all, starting off with this ASX 200 chart. So the breakdown from last week has continued into this week. And the ASX 200 is now broken below another key support zone. So it's this blue horizontal you can see on the chart. That comes in around 8,600. So it takes in a previous all-time high from February last year, as well as a secondary high in June. And the other notable development on this chart is that the moving averages are now quickly starting to roll over and may cross to the downside towards the end of next week. So does that mean we should be preparing for the worst? Well, I've seen commentary around breaks below the 50-day moving average. So there's a 50-day, and I've got the 100-day beneath there. I've seen some commentary around what happens when the market breaks below a 50-day moving average, and then I've also heard terms like a death cross to describe when the moving averages cross. And while that all might sound catchy, is it all really that helpful? And I think that on its own is actually not that helpful at all. So moving averages, as you may know, they're my favorite indicator. I talk about them every week, and I think they can be used to identify opportunities and help avoid risk. But I think an indicator, any indicator for that matter, I think it's only as good as your ability to interpret it. So last week I said that the break below the moving averages was like an orange warning flag, and this meant to be alert, know where your exit levels were, but not to panic. And I think that remains the message now. But simply dropping below moving averages doesn't send the market into an ongoing bearish decline. Well, it doesn't necessarily send it into an ongoing bearish decline. The key is what happens now that the ASX 200 is down here below those moving averages. Like, for instance, do we get a shallow bounce that struggles to retake the moving averages and then starts to roll over? That would be a bearish sign, and that'd be a sign that a muted rally is being sold. That's something to be concerned about. Should that sort of price action develop? Or is it a case that we get a V-shaped bounce that quickly takes prices back above the moving averages? Or is it more like an ongoing sideways movement that slowly starts to establish some sort of a base? And the thing is, like, no one knows which of those we're going to see, and we really need to wait and see how the price action develops. There's enough here already to say, look, it's time to be cautious. That's what we discussed last week. But I don't think there's enough here to justify some of the panic that we've seen in exiting some stocks. I've been managing this fall over the last week by sticking to my plan. So I've sold a few stocks this week. Some of them were big wins that I'd held for maybe a year or two. Others were modest losses, but they'd come back to their trailing stops or stop losses, and well, they left the portfolio. I sold them. But most of my portfolio was still intact and trading above wide trailing stops. And much of the selling, much of this selling that we've seen this week, well, look, it's been across the market broadly, but a lot of it has been concentrated in the financials. We discussed that last week. We had a look at the financials index. But it's also interesting to contrast that with what's going on in the materials index. So let me just quickly go across to the materials. So this is a ASX 200 materials index. So what we have here, this is a bullish structure. It has been and it remains a bullish structure. We've got rising moving averages. Prices are consolidating towards the moving averages after a strong rally off the September low. And the other key feature on this chart is that materials, which include basically include mining stocks, big 3-year trading range. Look at that big 3-year range there. Prices now appear to be breaking the top side of that range. So that's, of course, a bullish thing when prices break out of a range. And materials are a significant part of the ASX 200. I think it's hard to see or hard to imagine the ASX 200 entering an ongoing bearish phase if materials remain strong. Also having a look at the equal weight, ASX 200 equal weight. This has been a 7% pullback, but that 7% pullback follows a 37% rally. So when we look at it from that perspective, should we really be surprised to be seeing some volatility after such a big run? And of course, this could develop into something larger. Nothing says that what we've seen so far is just the start of something a lot bigger. Of course, that's always possible, but there's not enough here at this stage to suggest that that's the likely course of how this is going to evolve. At this stage, it looks like, at least to me, it looks like a pullback after a strong trending phase. I want to quickly show you something interesting. I saw this during the week. It's a magazine cover. Turned up on my X feed. It's from The Economist. It's from this month, and well, you can see for yourself how the markets could topple the economy. And you got the upside down skier. He's clearly up in high country in the Alps, and he's crashed, hasn't he? And so it's. It reminds me of a famous Business Week cover from, I think it was back in 1979. It was titled The Death of Equities. And anyone who knows a bit of market history will know 1979 was getting pretty close to the low of a very volatile 1970s period, which then went on into boom period in the 1980s and into the 90s. So the very bearish magazine cover appeared at the bottom. Now we've got another. We've got another bearish. We've got a bearish cover here, suggesting a crash. But is like in the 70s the magazine cover was completely wrong? Is the cover going to be completely wrong now? It's not to say that magazine editors are bad investors, not at all. But I think magazine editors are good at tapping into the public's psyche. They focus in on what's concerning investors. In the 70s, they tapped into investors' concern about equities going nowhere. Now they're tapping into investors' concerns about bubbles and crashes. So maybe it is, we are nearing the end of a bubble, but from my experience and from what I know about market history, true bubbles tend to catch most people off guard. But what we have now seems like more people are on edge and waiting for some sort of crash to occur. Coming back, just finishing up on the ASX 200. At this point, we've got an unpleasant 8% pullback from an all-time high. That in itself isn't really a surprise event. There are plenty of examples of similar pullbacks from all-time highs. The key is what happens now the market is below the moving averages, as we went through a little earlier. I think the performance of the material sector gives cause for a positive bias. And I also like that the equal weight index is also so far holding up relatively well. For me, it's about giving stocks plenty of room to move and trying to see off this pullback, but then also maintaining the discipline to sell if stocks come back to their trailing stops, not holding and hoping that stocks at 4 go back up, give them room, but then move them on if they come back to those stops. Now we're going to move on to the US market next, and after that we'll go on to the small caps and the commodities. And now, look, if you're getting some value from this, please hit that like button. Short comment, just what do you think the market's going to do? Are we on the brink of a crash, or is this what we often see, a pullback and then a recovery? What do you think? But also, look, leave that comment, click that like button. They help me heaps when you do that. All right, let's jump over to the S&P 500. So Thursday's price action. You can see Thursday. It was all about sell the rally. Prices gapped open on the high on relief that Nvidia posted good results, but that relief was met with persistent selling through the day, and the market then closed. S&P 500 closed down on its lows. And this takes the S&P 500 back to its 100-day moving average for the first time since May. So back over here was the last time the S&P 500 and the 100-day moving average moved in the same space. So far, prices have pulled back by about, from the October high, it's about 5%. But does this pickup in volatility now point to a bigger correction? And I'll come back to the S&P 500 in a moment. I want to quickly jump to the S&P 500 equal weight, because this has been important just through the week. So just looking at the S&P 500 on an equal weighted basis, because I think this provides an important insight to what's currently happening. So the big development here has been the equal weight has just broken down from a 2-month trading range. And I can just put that range in here. You can see the range. Last 2 months, we've had this sideways consolidation in the price action, and prices that had been consolidating along these moving averages, which had been broadly rising. I thought the odds favoured an eventual break to the upside, and we had this rally off the 100-day moving average last week. I thought that was encouraging. I thought that was potentially setting this up for some sort of a break to the top side in the weeks ahead, but that's not to be. We've got the break to the downside instead. The equal weight is also below its moving averages, and the moving averages are also starting to turn down. I don't think we can simply ignore these factors and push them to the side. The breakdown in the equal weight, I think, is a clear sign of some technical weakness. That said, there's not enough here at this point to say a bear market is inevitable. Sometimes we get breakdowns, but breakdowns don't always lead to big, long-lasting declines. I think the biggest issue for the market is declining participation. This breakdown in the equal weight, that's one sign of broad weakness within the market. But we can also see this better via an indicator, which I'll just show you now. So we looked at this last week. We looked at this for the last several weeks, really. It's the percentage of Russell 3000 stocks above their 100-day moving average. The Russell 3000 is a broad measure of the US market. We've been discussing this decline in participation for quite a while now. Several weeks, probably over well over a month, maybe towards a couple of months, and it's been a pointer to the current consolidation as the participation got down below its own moving averages and continued down. We've talked about that being a pointer to ongoing consolidation. This week has been interesting. The indicator has now hit a new low. It's down here, just you can see it here, down to around 35. So only 35% of stocks as of Thursday's close are still above their 100-day moving average. So in other words, 2/3 of the market are below their 100-day moving averages. Now, moderate pullbacks, and at the moment I've described what we currently have as a moderate pullback. Moderate pullbacks tend to end around this general vicinity. So you can see from the past, you can see these pullbacks in the indicator that come down to the mid 30s or maybe into the even the mid 20s. These tend to be associated with moderate pullbacks in the moment, and this is where they tend to bottom out. Not necessarily in one day and go straight back up. It can be a bottoming process, but this tends to be that region. Trips to the bottom, you see this blue shaded area. Let me just compress this a bit, get some more data. This goes back to around 2014. Trips down to the bottom where it's a complete washout and almost every stock is below their 100-day moving average. They're less frequent. They happen maybe every 1 to perhaps 3 years. The last one we saw was in April during the tariff sell-off. I don't think we have the evidence to suggest we're on the cusp of a major decline that would see another one of these washout events. I think the odds favour that it's more likely that it's one of those moderate declines where we are getting to the tail end of where the declining participation could end. Coming back quickly to the S&P 500. Just coming over to the S&P 500. As it stands, prices are only about, well, they're only around 5% from the all-time high, and they're trading near the moving averages, and the moving averages are still broadly rising. If we got bearish every time that occurred, well, I think we'd find it pretty difficult to stay on larger trends because, as we know, similar sort of things they happen quite a bit during upward trends. For a bearish structure to develop, I think we need to see prices below the moving averages, and then we need to see the moving averages turn lower, and then we need to see a rally back towards the moving average fail, like earlier this year. See, there's a break below the moving averages turn, rally back to the moving averages fail, prices roll over. That's the concern if that sort of price action happens. Similar stuff back in 2002, below the averages turn, rally back fails, selling of the rally, and that's when things get ugly. At the moment, we don't have that. Yes, it could develop into that, but we don't have it at the moment. The breakdown in the equal weight and declining participation are causes for concern, but I don't think they're reasons for panic. I think it's a case of managing risk carefully. For me, it means exiting stocks that come back to their trailing stops, holding stocks that don't give me a reason to sell. I don't want to sell every time things get a bit wobbly because often wobbliness doesn't turn into bear market trends. It's about trying to see off a pullback, not getting swept up in a panic to sell everything. I want to finish with one other graph. I've got a graph I want to show you. Just like all this talk about bubbles we've heard recently, I'm hearing it on the nightly news. I'm hearing it on the various news feeds, chat sites. A lot of talk about bubbles, and I think that's feeding into the fear with this current pullback. So just have a look at this. Another thing that turned up in my Twitter feed through the week. This does a great job of comparing the current NASDAQ, what the NASDAQ has done over the last, since October 2022. They're using October 2022 as the start point, which was a notable low before the latest bullish phase started. And they're comparing it. You can see it in red. You can see the current NASDAQ in red, and they've overlaid it with bubbles of the past. So here's the great 1920s bull market, much bigger. The gold boom from the 70s, again, much bigger. Here's the Japanese stock boom of the late 80s, early 90s. There we are now, much bigger. There's a dot-com boom, much bigger. And you can see bubbles have like a true acceleration at the end. Like look at the acceleration towards the end of a bubble. I don't think we have that here. There are a couple more down here, but I think those top four are the most interesting. So just pause that, have a look at at leisure. Um, near term, I think we could expect. I think we should expect some more volatility, but I think try not to get swept up in other people's fear. Know where your exit levels are, follow your plan, and make rational, unemotional decisions. That's how we see off. That's how we see off these periods and manage our risk should these periods develop into something bigger. Okay, I'm going to go over to the US small caps next. We've got the Aussie small caps, we've got the commodities. We're going to go through your stocks, see what they're doing. But of course, that wraps up the free section. If you're not a strategy session member, link below, click that, come in. We're going to talk about heaps more interesting stuff. And for the little money it costs to put it all on for you, I think it's probably the best value play you're going to find. All right, so let's go over and let's start with the Russell, the US Russell 2000, the US small caps.